Good morning, class. This morning, we'll be looking at financial institution, specifically the definition of financial institution as well as central bank. Financial institutions refer to all business organizations which hold money for individuals and institutions and may borrow from them in order to give loans or make other investments. They represent the main channel or medium by which funds can flow from lenders to borrowers. Types of financial institutions. Financial institutions may be divided into two major groups, that is, banking and non-banking financial institutions. The major difference between the banking and the non-banking financial institutions is that the liabilities of the banking institutions are counted as part of the total supply of money, while those of the non-banking institutions are excluded from the money supply. Banking financial institutions include commercial banks, central bank, merchant banks, development banks, saving banks, while non-banking financial institutions include insurance companies, hire purchase companies, building societies. Central bank. A central bank is a federal government-owned apex financial institution which controls and supervises the entire monetary system of a country. In other words, it is the highest financial institution in a country which carries out the monetary policy of the government. It is the sole authority in the banking industry which acts as banker to the government and the commercial banks. Functions of central bank. 1. Banker to the government. The central bank collects all revenues accruing to the government from taxation and other sources. It makes payments on behalf of the government and advises the government on monetary policy. 2. Banker to other banks. The commercial banks and other financial institutions keep a percentage of their deposits with the central bank as legal reserves or special deposits. It also offers clearing house facilities for settling interbank indebtedness. 3. A lender of last resort. It makes loans to commercial banks and other financial institutions to enable them meet unusual cash demands by customers. This helps to prevent monetary crisis. Instruments used by central bank to control commercial banks. 1. The bank rate. This is the rate at which the central bank will discount first class bills. If the bank rate is high, commercial banks would increase interest rate and this will reduce the ability of commercial banks to create credit. 2. Liquidity ratio or cash ratio. This refers to the legal reserve requirement or the ratio of commercial bank cash reserve to total deposit. If it is decreased, the lending power of commercial banks would increase. 3. Open market operation (OMO). This involves the buying and selling of securities such as treasury bills from or to the public. Buying from the public would increase the cash available with banks, thereby increasing their lending power. 4. Moral suasion. The central bank has a way of persuading the commercial banks on what their lending policy should be. They can persuade the commercial banks to give loan to agricultural sector or educational sector. Number 4. Special directive. The central bank can authoritatively direct the commercial banks on which sector their lending should go to. Traditional financial institutions. The traditional financial institutions came into existence several years before the establishment of modern banking system in many countries in the West African sub-region. These traditional financial institutions usually take the form of cooperative societies known as credit and thrift cooperative
Good morning,
societies,
class.
which are given
This
different
morning, we'll
names
be looking
in
at
different
financial
places,
institutions,
e.g. Esusu or Nsusu
specifically the
in Yoruba
definition of
or
financial
Etio
institution,
Utu in
as
Igbo.
well as central bank.